Top drilling, nice share transactions, statement of changes in equity, conversion of shares, redemption of shares, and a nice little twitch in the tax calc. Top Drilling is a company involved in large drilling operations such as mining and fracking explorations where prospecting and gas extraction are taking place. The company was incorporated in the late 1990s, and as a result of the technologically advanced equipment that they use, they are very much in demand for performing these kind of drilling operations. It was recently discovered that fracking could be an economic viable option in the Waterberg region. The current equipment that the company uses for fracking is all occupied in the Karoo region, where fracking seems to be a definite possibility. Should they accept a fracking exploration project in the Waterberg region, they will have to acquire new equipment at a cost of 10.95 million rand. You are the financial manager of TD. The financial year of the company is 30 June. Always important information. The Board of Directors is eager to receive the 2017 financial statements of the company to assist them in the decision of how the 10.95 million rand should be raised. The entity adopted the function method for allocating expenses in the preparation of the statement of profit or loss and other comprehensive income. The following information for the year ended 30 June 2017 was presented by the senior bookkeeper. Now, the first part of the question wants you, obviously, if you look at that income statement, it's rubbish. Critically, not the information, the way it is disclosed and the presentation is totally rubbish. Critically analyze the disclosure of the statement provided as according to IS1. I'm not going to do that. I'm going to waste valuable video time and data if I'm doing that. You can go and have a look at the answer and the memo and see whether you have actually picked up all the problems associated with that income statement. The second part is a statement of changes in equity, and that I will do in detail with you. Okay, so here we have, if I'm just going through the income statement, we have income from drilling machines in mining, fracking, maintenance costs, employee benefits, interest paid, fuel and lubricants, admin, selling, other expenses, depreciation. We have a revaluation and surplus on land, which is standing here. That's something you have to take care of. 220,000, and a very important mistake that they made is they put it above net income after taxation. And also they talk about income after taxation. Nowhere here is tax, so this doesn't add up to anything, guys. So that means that must just be a figure that I've just slotted in. It didn't add up like it should. Additional information. Authorized and issued share capital. TD has authorized shares of 13.5 million ordinary shares, 2.8 million 8% compulsory redeemable preference shares, and 4.8% 6% non-cumulative compulsory convertible preference shares. All the shares are no par value shares. The issued shares at the beginning of the year was 5 million ordinary shares at 5 rand, so in our statement of changes in equity. Proper heading, ordinary share capital, 5 million at 5, 25 million rand. 400,000 8% compulsory redeemable preference shares issued at 10 rand each. That is not equity. If you did put it in the statement of changes in equity, minus 5 marks. So in a separate account, we can account for that. 8% redeemable pref shares. The 1st of July opening balance, 400,000 times 10 equals 4 million rand. And then 600,000 6% compulsory convertible pref shares at 12 rand each. So again, in our statement, 6% cumulative shares, 600,000 times 12 equals 7.2 million rand. On 1 January 2017, 40% of the compulsory redeemable pref shares were redeemed at 10 rand 50 per share. Now, what we have to take note at the capital, the issue price. We have issued it at 10 rand a share. So we're going to give the shareholders of these preference shares 50 cents per share additional. Well, let's do that one first. It's redeemable pref shares, so it's not in the statement of changes in equity. we are going to redeem 40% of those 400,000 shares, so that equals 160,000 shares. Now, 160,000 shares multiplied by the redemption price of R10.50 a share gives us 1680. How much can we take out of the capital account? We can only remove 160,000 shares at R10 a share. So we can only take out of the capital 1.6 million. The remaining 20 cents a share, 50 cents a share, sorry, we're going to pay it back at 50 cents a share. So the remaining 50 cents a share, i.e. 80,000 Rand, that premium we're going to take out of our retained earnings. So our retained earnings, we haven't seen what the opening balance was as yet, but we know that this premium of 80,000 Rand is going to be against retained earnings. What is our journal entry? Debit retained earnings, 80,000 Rand. Debit 8% redeemable pref share capital account, 1.6 million. Credit bank, 1,680,000 Rand. At the same date, so also 1 January 2017, another 200,000 compulsory convertible pref shares were issued at 17 Rand per share. So that definitely, applications for 160,000 compulsory convertible shares were received, and the shares were allotted after an underwriter's commission of 2% on the issue price was paid. The company's accounting policy states that distributable reserves should be used to write off any share issue costs. Good, so it is a fresh issue of capital. What is the first question that comes to mind? Was there an underwriter involved? Yes, there was. What was the underwriter's commission? 2%. How many shares did they want to issue? 200,000 at 17 Rand. How many shares did they issue? 200,000 times 17 Rand, because for the shortfall, the underwriter has taken it up. So the first issue was 200,000 times 17, and then they had to pay a 2% underwriter's commission, and we should have used distributable reserves to write off any underwriter's commission. Issue 200,000 times 17, 3.4 million. Our underwriter's commission is now going to be based on the 3.4 million, 2%, and that is going to go against retained earnings, 68,000 Rand. On 1 February 2017, the company decided to convert 50% of the old, i.e. the previously issued pref capital convertible shares at the beginning of 2017 into ordinary shares in the ratio of 1 ordinary share for every 5 preference shares held. Okay, so first one is the conversion of 50% of the opening balance. So 50% of the opening balance equals 3.6 million. It's a share conversion. So what do? We move from one class of equity, that amount of capital, into another class of equity. So we just take out the 3.6 million here, and we're going to issue them ordinary shares in return for their previously held preference shares, 3.6 million. The second thing is, how many ordinary shares are we going to issue? Well, they are going to receive in the ratio of 1 ordinary shares for every 5 pref shares held. Now, how many pref shares did we convert? We converted 50% of 600,000 pref shares. So we have converted 300,000 pref shares. And for each 5 of them, they're going to receive 1 ordinary share. So divided by 5, multiplied by 1. So they're going to issue 60,000 ordinary shares in return of this 3.6 million pref share capital, which they're going to cancel. Revaluation surplus. It is the accounting policy of the company to use the revaluation model for property, whilst the cost model is used for all other items, property, plant and equipment. Property was initially bought for 580,000 Rand on 4 April 2002. And at 30 June 2016, it was recorded and disclosed at a fair value of 700,000 Rand. So the value of our property has increased from 580 to 700,000 on 30 June 2016, so in the beginning of the year. So what is our opening balance of our revaluation surplus? 700,000 less 580,000 rand. So revaluation reserve, 700 less 580, 120,000 rand. The company made use of a sworn appraiser who valued the land again on 30 June 2017. The revaluation surplus shown in the provided statement represents the difference between the current year's valuation and that of the previous financial year. So what they're actually telling you is that the movement which took place in the value of land from last year to now equals 220,000 rand. So that's our current year's movement, 220,000 rand. So closing balance of our revaluation reserve, 340,000 rand. Profit. The retained earnings on 1 July was 9,870,000, so you can slot that in, 9,870,000. Taxation is charged at 28% of taxable income. You can accept that the taxation charge was correctly calculated for the 2017 financial year. No dividends were taken into account when the statement provided was prepared. So what I tell you is that 8,680,000 net income after tax represents the correct calculation with its 28% tax included. But what was not taken into consideration was any interest, and the only interest that we know of is the interest on the redeemable preference shares. So if we go to our profit calculation, profit after tax, 8,680,000. That is this 8,680,000 there. Let's go and calculate our interest on our redeemable pref shares. Opening balance 4 million rand. So from 1 July to 1 January, the outstanding capital was 4 million rand multiplied by 8%, and that was for 6 months. So that is 160,000 rand. From 1 January up to the end of the financial year, the outstanding balance was 2.4 million rand times 8% for 6 months, give us another 96,000 rand redeemable pref share dividend. So the total redeemable pref share dividend, i.e. our interest, was 256,000. Now, when they compiled that statement that you out, they never took into consideration this 256,000 rand. Now, that net income after tax of 8,680 was after they took into consideration the 220,000 rand revaluation surplus. So, actually, what the 8,680 was not net income after taxation, that was total comprehensive income for the year of 8,680,000. So that total comprehensive income for the year, we should actually now sort of restructure. We should do something with that. We have to massage it into something that makes sense. So we can say net income after tax was 8,680, but that included a profit in inverted commas, i.e. the surplus on the revaluation of land of 220,000. So the actual profit after tax was only equal to 8,460,000 after tax. So if you want to convert it into a before tax figure, we're going to divide it by 72% because the tax rate is 28%. So profit before tax, 11,750. Now we're going to deduct the interest on the redeemable pref shares of 256,000, and that gives us then net income before tax of 11,494,000. We're going to apply our 28% tax rate on the 11,494, and that's going to give us profit after tax of 827,560. The other alternatives that you could have done, I would not recommend it though, but it wouldn't have been wrong, is if you have massaged your net income after tax first to get your actual net income after tax, which is then the 8,460,000. So the first part of those two steps are exactly the same. Then, instead of going back to a before tax figure, deduct the interest from before tax interest from a before tax profit figure, you cannot work with before and after tax combined. You must either work with before tax figures, like we've done here. We converted the profit after tax into before tax, then we deducted the interest, which is the before tax figure, and then we reworked the tax. Or if you wanted to take shortcut, you could have converted that interest, 256,000, into an after-tax interest. So the receipt of revenue is going to allow you the deduction. So therefore, the impact of that interest on your profit after tax is going to be the 256,000 multiplied by 72%. That is going to be the amount with what your profit after tax is going to be reduced once we've recognized that interest. And that gives us then an after-tax interest of 184,320, and that will bring you back to exactly the same profit after tax, 827,56850, 827,568. However, there was only one adjustment that we made here. Therefore, you can take the shortcut. But please do not take the shortcut if there are more than one adjustment that you have to make to your profit before tax, because then you are going to make a mistake. So maybe just to play safe, go the long route in any event, convert your after-tax figure into a before-tax figure. Then do all your adjustments like you used to. You are used to calculate interest like this. You are used to any other, let's say there was depreciation that you had to subtract. You are used to working with before tax figures, so do that before tax. And then right at the end, then rework your taxable income, rework or recalculate your tax in order to get to your net profit after tax. And then you dump that in your statement of changes in equity, 8275680. The last one is all about dividends. An ordinary dividend of 80 cents per share, as well as dividends on all classes of preference shares, were declared on 15 June 2017. Dividends will be paid on 1 August. That doesn't matter because we have already declared the dividend and therefore we have to take it into consideration. So let's do the dividend declaration first. The fact that we've declared an ordinary dividend means that we've also declared our pref dividend. So let's go and work out our dividends. If we talk about ordinary dividends, we had 5 million, we had another 60,000. So we had in total dividends, ordinary dividends, 5,060,000 at 80%, which gives us 4,048,000. On our convertible pref shares, we had 7.2 million outstanding from the 1st of July up to we've converted some of those shares only on the 1st of February at 6%. So 7.2 million times 6% for 7 months equals 252,000. On the remaining 3.6 million, after we've done that, that happened on the 1st, that would be then the 7.2 less the 3.6, there's then the other 3.6 that stays behind, times 6%, multiplied by 5 months, then 90,000, and then the issue of the new shares, 3.4 million, it was issued on the 1st of January, so that was outstanding for 6 months, multiplied by 6%, and that will give us then 102,000. So total pref dividend 444. Total dividends declared then would be the 4,048,000 plus the 444,000. 444 plus 448, dividends 4,492,000. We've already dealt with the redeemable pref shares because we've already worked out the interest and took it into consideration. Now, settlement of the outstanding dividends. Now, this is a different ball game. Will be 100% in cash for the preference shareholders, but 80% of the ordinary dividend will be settled by ways of a capitalization issue of ordinary shares. Now, that is all about the settlement. So you have to determine whether settlement of the dividend was taken place in the current financial year or whether it's going to be taken place in the next financial year. They tell you that the capitalization issue was completed by 30 June 2017 and all shareholders are natural persons. The fact that that capitalization issue was completed by 30 June, then it means that the cash dividends was payable on 1 August, but that's got absolutely nothing to do with the capitalization issue. So I will have in my statement of financial position as part of current liabilities my shareholders for dividends, which will then be equal to my cash dividend, which is still payable. But for the dividend which was settled by ways of a capitalization issue, that was completed by year end. So I have to update my statement of changes in equity with that capitalization issue that took place. So let's go and have a look at the calculation of that capitalization issue. 80% was made by ways of the issue of new shares. That 20% cash 809,600, that will again be split 80-20. 80% will be shareholders for dividends in the statement of financial position. 20% will be SARS dividend withholding tax in the statement of financial position. But that 323,800 will have to go to my statement of changes in equity right at the end of the year as part of my ordinary shares. I am going to issue ordinary shares to settle that dividend. And that's in the end of the question, because then I'm going to add this in, get my final figures for the year per class of equity item.